Hey, and welcome back to the Heinz and Clark podcast. You can probably see that we have an additional guest again today. This is Ethan Miller, a senior accountant at Heinz and Clark. Today we're going to be talking about cost seg, who it benefits, who can take advantage of it, and kind of what we do from a report standpoint, and a really quick example of what it can mean from you from a tax savings standpoint. So I'll let Steve jump in and introduce all that.
Yeah. So what is cost segregation? So cost segregation is typically on the purchase of an investment property. So think like a commercial building. It could be an office building. It could be a
Warehouse.
It could be an apartment building. We've done these cost segregation analysis and reports on all of these. But essentially what we're doing is we're inventorying and pulling out the various components of the building. So when you depreciate a building, you have to first pull out the land, which cannot be depreciated, and then the next part is the structural component of the building. And if you don't do a cost segregation, then you're depreciating that over 27 and a half years or 39 years, depending on the type of property it is, which is a long time to get some of that depreciation back. With the cost segregation report, essentially we're pulling out the items that can be depreciated over 5 years, 7 years, 15 years, and we're assigning values to those based on what's actually in that building or property that you purchased. And then we can accelerate that depreciation over that period of time. And under current tax law, we can even take bonus depreciation on those 5, 7, 15-year property to potentially get you a significant tax loss from the depreciation in year one that you purchased the property. So who does this benefit? Really, it's real estate investors. I'm not going to get into passive activity losses on real estate, but there are some rules specific to who can take losses related to real estate losses. But if you are a real estate professional, a realtor, or if you are already a real estate investor, then more than likely this would benefit you. So the benefit to this would be in year one of purchasing the building. So ideally you'd want to do it that same year or before you do your next tax return that you're going to be reporting this hopefully large loss on. And that would be the time to do it. And Ethan's here. He works a lot in our real estate side of our business that we work with, clients, investors, realtors, and professionals. And he does a lot of these reports. So we're going to kind of walk through a high-level example here of one. So.
Yep. So kind of how we start is we get a feel for the property. So we go to the physical location. With that, we kind of do an inventory count to see what is all in the property. And then with that, we kind of break the assets into their buckets. Those buckets are 5, 7, 15, and if they default to 27 and a half or 39 year. And with the 5, 7, 15 year, those are eligible for bonus, as Steve mentioned. So that's kind of the step one. And then after we gather that information, we put it into a report, which separately breaks all those items down. And we'll just give kind of a quick example of that. So say you buy a property that cost $1 million. We're able to put anywhere from 20 to 40% of those assets into those buckets that are eligible for bonus depreciation. So we'll go with 40% that we're able to pull out and accelerate the depreciation. So $1 million property, we're able to pull out $400,000, and then we'll go with a marginal tax rate of 30%, which that's going to be $120,000 in tax savings taken in the first year.
Yeah, so I think to kind of further this example a little bit, so let's say you buy that $1 million. Typically, you need to put 20% down. That's a down payment, right? So you've put $200,000 down and leverage the rest through a bank loan, let's say. So you've put $200,000 down in cash on it. Let's say you bought it in January or July 1st, right? So July 1st, you put the $200,000 down. You file your tax return in March or April of the following year, and you're getting $120,000 back just in tax savings. So you're saving that money that was normally going to go to Uncle Sam or the IRS, and now that's coming back into your pocket. So essentially, of that $200,000 investment you've made, you've just recouped $120,000 of it in year one, not even factoring in any cash flow that you've potentially received from the property also. And what Ethan does, it's a formal, roughly 10-page report that's created, and really the benefit to that is, one, it's based on principles related to how this is supposed to be done, and this analysis is supposed to be done. But then it also provides you information. It's a document you can hand to the IRS if you're ever audited on this very specific loss that you're claiming. And Ethan also does an analysis. We kind of went through some very high-level, basic assumptions on numbers and tax rates, but he also does put together an analysis that's more specific to that individual and their tax rate. So even kind of shows a net present value and tax savings the first year. And so there's a lot of information in the report. Ultimately, I think the key is that $120,000 tax savings that Ethan mentioned. So.
Mm-hmm. And under current law, so bonus depreciation is eligible for 100% in the first year. But starting in 2023, it's going to be phased out by 20%. And that's going to last to 2027 until it's entirely phased out. So that's kind of something to keep in mind,
Yeah, I think it's a good point too
forward.
for planning too, and probably this will be more a year from now when we're talking with people maybe about if you're looking at buying something that's getting close to the end of the year, maybe speeding it up can help from a variety of ways on some of that too. So, and we should maybe say too that what we specifically talked about was really just the federal side of this. States are all different in how they handle bonus depreciation. Minnesota doesn't allow you to take all of it, some of it. So this doesn't even factor in the benefit on the state side of it. So, which, like I said, is probably smaller, but also can provide a little additional value. So.
Yeah. So a lot of good stuff in these cost tags. A lot of the times, the people that we see it benefiting it, and where you can really take advantage of this, if you're having a big year in business, and whether it could be even an outside business. Steve and I have used this on a number of properties to really reduce taxes overall in what we do, and it's just a really slick way to make sure you're taking advantage of your investments and getting money back out of your properties as quickly as you can, because like Steve said, you're putting so much down right in the beginning. So I
think that's it.
Show.
Yeah.
Give us a call if we can help you with this.
Or if you have questions on it.
Yeah.
All three of us can help you. So
we all three have phones.
We do. They all work.
So yeah. Well, we can't guarantee that. No, they all work. So thanks a lot, and check on our socials or click on our socials or whatever that thing is. Do the socials. John, you're in the background. Is that what it is? Am I right?
He's nodding yes.
Yeah. So that's it. You gotta click social things. Do it.
All right. Thanks.
Yep.